This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
The stock market is currently in a real tankathon, which means we're going to, at some point, end up with some pretty extreme good values in stocks. I don't know if we're quite there at this point. I think much of the damage we've seen so far this year has mostly been because interest rates have gone up so much. Only recently, I think we've started to see some of the recession odds starting to get priced into stocks. So there certainly could be some more pain ahead. However, keep in mind that what you and I are trying to do is accumulate businesses that are high quality and will produce cash flows for the next 10, 20, 30 years. So 1 year, is certainly part of the equation, but over the next 20, 30 years, what ultimately matters more is the competitive position that the business is in and what kind of cash flows and business model it has. That's going to be the biggest driver of your long-term performance, not necessarily whether we have a recession next year or not. So how do you value stocks? That's a question that I've gotten from a lot of people. It's a very complex topic. I'm currently working on a course that will help you answer that question. How do you value a stock? I'm hoping to have that ready at the end of 2022. If I don't have it ready by then, I probably won't have it ready for at least a little while because we're having our fourth child actually in January. So I'm not going to be available to do a ton of videos at that point in time, and whatever videos I do make, I'll probably be so tired they'll be terrible videos. So anyways, hoping to get it done by year end. But in the meantime, there is a tool that I wanted to show you all, and it's called Fast Graphs. Full disclosure, I am not sponsored by Fast Graphs. I did get a free subscription. I actually talked to the founder of Fast Graphs. His name is Chuck Carnegie. And fantastic guy, by the way. He spent about an hour on the phone with me, walking me through the software, answering any questions I had, and was just a generally solid guy. I think I really liked him. So again, not sponsored. There's no affiliate program for this. I will put a link in the description down below, but you should totally go check out the platform, get a subscription if you like what you see. So we're going to walk through a couple of different stocks and just see what this tool is all about. Okay, so this is a screenshot of the tool. I'm on the website right now, and so you can go in here in the upper left corner and put in whatever ticker symbol you want. So I've got pulled up here, Apple. So what this tool does is basically it measures what the average price to earnings ratio is for a particular stock using whatever look back period you want. So here I've got the maximum selected, and so what it does is it plots different lines. The two I want to focus on is this orange one, which is simply PE of 15. So basically, if Apple had traded at a price to earnings ratio of 15, we basically take that multiplied by the earnings per share at the time, which were $5.61, and that gives us the estimated price of $84. However, the actual price of Apple at the time was this black line, nearly double the PE ratio of 15. So that was actually trading at this blue line. Now this blue line represents the average PE that Apple traded at over this time period. So basically, if Apple had traded at 25 times earnings back here in September 2015, it would have traded at a price of $58.86 based upon the earnings at the time of $2.31. But you can also take a shorter look. So maybe you say, I want to know what the average PE was over, say, the last 7 years. Okay, so if we look at that, we find that the average PE over this time has actually been here in the right. Actually, I don't know if you can see that, sorry. So the actual PE has been 21 times over this period. If we change to 5 years, the average PE over the last 5 years has been 26.46. So you can see there's a lot of different ways that you could calculate the average PE. What I typically do when I look at this is just keep it consistent, right? That's, I think, the most important thing. So if you want to look at the average of the last 10 years on PE and you're maybe evaluating 5 different stocks, just keep it consistent between those five. And I think that'll give you a pretty good idea of which one on a relative basis is the most undervalued. So let's do that here. What I'm going to do is I'm just going to show you kind of how I use this little tool, and then you can play around with it if you do decide to get it. There is, I think, a free trial that you can sign up for. But what I do is I look at some time periods. So here I've got 10 years. I take the average PE that's been over that period. So in this case, we'll call it 18.2. And then you can go over here to forecasting calculators and click over here on custom. And I like to use the estimates. So what this does is it plots the analyst estimates for earnings for basically as long as they have it. So in this case, you can see they have analyst estimates here for 22 at $6.09, for 23, $6.41, for 24 at $6.79. And then you'll notice these longer term estimates are simply a 12% growth rate based on the prior estimate. I think that's probably a little high for Apple. So what you can do is come in here to custom growth rate and enter something. So I'll say 9 and draw it. Okay, so basically what this is saying is if these estimates come true, Apple's operating earnings per share will be $9.03 in September 30th, 2027. And then it gives you what the price would be at different price to earnings ratios. So if those earnings came true and Apple traded at 15 times earnings, the price would be $135.43, which would be a total return with dividends reinvested of negative 7.6% or negative 1.5% per year. However, what we know about Apple is that it's generally traded above 15. It's the average over the last decade was 18.2. And that may even be a little bit understating Apple's kind of fair PE. I think people rightly think of it more as a consumer staple at this point, which tend to have higher PEs than average. But let's just say 18.2 is kind of our midpoint. If it trades at 18.2, again, we see a fairly disappointing total return out that far at just 2.2% annually, which is less than what you could get in a treasury yield. But if you said, well, I think Apple's going to trade, say you think they're probably going to trade more at 25, which is right about where they are today, you can also apply that, and you can see that now if it trades at the same PE and hits these growth numbers, whatever you input, now we're looking at a total return of about 8.6% per year. So anyways, you can see how there's different ranges. So if it trades at 37.5, which I don't think is going to happen, you'd make 17.5% a year. And if it trades at 12.5, which is be pretty bad, you'd lose 5% per year. So this kind of gives you a really simple and easy way to kind of understand where the growth could be coming from whatever stock you're looking at, and you can put in whatever estimates you think are going to happen, draw them, and then kind of figure out a range of potential scenarios for where the stock could be out longer term. Let's pull up another one here. Let's maybe take a look at Home Depot. So I'm going to go back to this historical chart. Use the 10-year average PE, has been 22.3. So I go back to the forecasting calculator, click on custom. I'm going to use the estimates. And I'm going to put in here the average PE of the last decade of 22.3. Hit apply. And one last thing, I'm also going to tamp down this growth rate. It looks like analysts have 10.5% long-term growth rate. I think that's a little rich. I'm going to do 7 instead. Going to go ahead and add that in here. Oops, deleted my PE. Hit apply. Okay, so if Home Depot gets to just under $23 earnings per share in 2028, and they trade at their average PE over the last decade, this calculator suggests you would make 14.7% per year with dividends reinvested. Will that happen? I have no idea. This is not a suggestion to buy Home Depot or any other stock, but at least if they do hit these numbers, it looks like Home Depot is most likely, relatively undervalued. They're trading at between about, 16.6 times trailing PE at the moment. If they just trade a little bit below that even, and they hit these numbers, your total return would be about 8%. So, I think that's pretty favorable. The big question obviously is, can they hit these numbers? If you do go into a recession, obviously you can probably throw out these numbers here. Home Depot probably is going to have a lower earnings per share number in these next couple of years if you have a recession. But longer term, if they can hit these numbers, it looks pretty cheap to my eye, at least. Then I'll also show you one other thing. I've gotten a lot of questions about how to value REITs. So let's look at one. Let's just do American Tower. So there's different metrics that you can use. You can look at the average earnings. You can look at diluted earnings, which are accounting for any options that are outstanding. You can use operating cash flow, free cash flow to equity. There's sales. There's all kinds of metrics that you can use. In this particular case, for a REIT, usually REITs, you want to use adjusted funds from operation, which is here. So I'm going to click on adjusted funds from operations, and I'm going to look at the maximum price to adjusted funds from operation ratio, which has typically been 23.3. So again, I can go to my custom tab, click on the estimates, and now it's going to give me the adjusted funds from operation estimates for American Tower. And I can put in my 23.3 average 10-year number, hit apply, and now it's going to show me, what I might expect to earn if they hit these numbers and if the multiple stays about where it was over the last 10 years, which again looks pretty attractive for American Tower. I think you'll find that's a pretty consistent theme across the board. A lot of stocks look pretty attractive at the prices they are currently trading at. Obviously, the big question is, well, what happens if earnings just absolutely fall apart? Maybe then you've got a different story. But at least if you can have a soft or soft-ish landing, even a mild recession, stocks are probably fairly attractive in a lot of cases. But certainly there are big downsides that could potentially be ahead if you enter some kind of a 0809 type recession. Obviously that would be terrible for the market. But we'll see. No one knows exactly what's going to happen. We're all just kind of guessing. But I think the best thing you can do at the moment is look for value, focus on what these companies are likely to be earning, what they're likely to be paying in dividends out, 5, 10, 20, 30 years. As long as you can stay focused on that, you can think about these stocks as, just fields, right? That you're buying the fields and you're getting props essentially off of those fields year after year after year. If you have a bad year, you have a drought, whatever, ultimately it's not going to affect the intrinsic value of that field all that much. As long as you have good soil, i.e. a good business model, I think you can have confidence that buying at these levels is going to ultimately pan out. Whether that works out in the next 6, 12 months, maybe a different story, but longer term, I think you have to like where stocks are trading at in a lot of cases. Thanks to everyone who is sponsoring the channel on Patreon or on YouTube Premium. If you haven't seen the S&P 500 valuation video, I did post that. We're also doing the monthly subscriber Q&A. So if you have a question for that, go ahead and put your question in and I will answer it here in the next week or so. If you're interested in supporting the channel, I'll put a link in the description below. So again, shout out to the people at Fast Graphs, Chuck and Polly specifically. Appreciate you all hooking me up with a free subscription. Really appreciate and enjoy the ability just to plug in any name and value it or get a general idea what the potential fair value of the stock could be without too much effort. So for a quick way to value stocks or at least get an idea if you might be interested in doing more research, I think this tool is absolutely fantastic. Thanks for watching and I will see you in the next video.